Okay, so you want to own a trailer park. Good news, this might be the cheapest way into real estate in America. Frank Rolfe bought his first one in 1997. The park cost $400,000. His down payment was $10,000. Today, he and his partner have ranked as high as the fifth largest owners of manufactured home communities in the country, with a portfolio once valued at over $1 billion. And here is the part nobody tells you at the start. You will own the land. You will not own a single home on it. Every house in your park belongs to the person living in it. You own the dirt underneath. That sounds like a disadvantage. It is the entire reason the business works, and it is the reason one investor called it a Waffle House where every customer is chained to the booth. By the end of this video, you will understand why owning none of the houses is more profitable than owning all of them. You will understand why the man who built an empire on this once admitted, out loud, that the model only works because the residents are trapped. You will understand why Warren Buffett quietly owns the factory that builds the homes and the bank that finances them, but not the land. And you will understand why the single most affordable housing in America is being bought up, lot by some of the largest investment funds on earth. Start with the price of entry, because it is genuinely low. An apartment building priced to sell will cost you millions. A trailer park lot, averaged across the whole country, is worth somewhere around $10,000. Buy a 100-lot park, and you are often paying less per unit than a single-family home. The barrier that keeps out most real estate investors, the enormous upfront capital, is simply not there. That is why for decades this was a mom-and-pop business. Roughly 70% of the country's parks are still owned by individuals, many of whom bought one park, ran it quietly for 30 years, and never raised the rent to what the market would bear. That last detail is the whole opportunity, and it is where the business turns. Because when you buy a park, you are not really buying the homes, and you are barely buying the land. You are buying a rent roll that the previous owner deliberately kept low. Here's the mechanism. In a normal rental, if the landlord raises the rent too far, the tenant leaves. That threat is what keeps rents in check. In a trailer park, the tenant owns their home, and the home does not move. It is called mobile, but moving one is a fiction. Transporting a manufactured home to another park costs somewhere between $3,000 and $10,000, and many older homes simply do not survive the trip. So when your rent goes up, the resident cannot vote with their feet. Their single largest asset is bolted to your land. Frank Rolfe described this more honestly than any critic ever could. In a training seminar for aspiring investors, talking about raising rents, he said the quiet part into a microphone. One of the big drivers to making money is the ability to increase the rent. And if we didn't have them hostage, if they weren't stuck in those homes, it'd be a whole different picture. That is not an opponent describing the industry. That is the fifth largest owner in the country describing his own business to people paying to learn it. And it is worth knowing who is saying it, because the origin story is part of the pitch. Rolfe likes to tell people that if you have $10,000, you could buy a mobile home park just as he did in 1997. What that line leaves out is that the $10,000 was only the down payment on a $400,000 park, and that Rolfe had sold a billboard business the year before for nearly $6 million. The bootstraps version sells better. He and his partner Dave Reynolds turned that first park into Mobile Home University, where a weekend boot camp for aspiring owners runs around $1,700 and a home study course several hundred more. The business is no longer only owning the parks. It is teaching the next wave of buyers the exact math you are about to see. And that is only half of the structure, because the genius of the model is not just that the tenant is stuck. It is what a rent increase does to the value of the park itself. Watch the math. Say your park has 100 lots, and you raise the rent by $25 a month. That is $300 a year per lot, $30,000 a year across the park. Modest. Almost invisible on any single resident's bill. But commercial real estate is not valued by its rent. It is valued by its income divided by a number called the cap rate. At a cap rate of around 5.5%, which is roughly where these parks trade, that extra $30,000 a year does not add $30,000 to the value of your park. It adds more than $500,000. Read that again. A $25 rent bump, small enough that most residents grumble and pay it, can increase the market value of the park by over $500,000. You have not built anything. You have not added a single lot. You raised the rent by less than $1 a day, and the asset revalued itself upward by a fortune. This is the real product, not shelter, not land. A machine that turns tiny, near-forced rent increases into enormous jumps in valuation. And this is why the low starting rents are not a problem to fix. They are the whole reason to buy. When Rolfe talks about why parks are undervalued, he describes an industry where mom-and-pop owners kept rents at roughly half of what the market would bear, because for 30 years they never thought of the park as a machine. Every one of those underpriced lots is a lever nobody has pulled yet. You are not buying a park at its current income. You are buying the gap between what the last owner charged and what the resident, unable to leave, can be made to pay. The wider that gap, the more the park is worth the day you close, before you change anything at all. In the language of the business, that is not exploitation, it is upside, which is exactly why the mom and pop era is ending. For a long time, the big money ignored this business. It was unglamorous, fragmented, and carried a stigma. Then the funds ran the same math you just did. The first mover was a billionaire named Sam Zell, once the largest owner of office towers and apartment blocks in the country, who became by a wide margin the largest owner of manufactured home communities as well. When the man who built empires in Class A office space decides your trailer parks are the better asset, that tells you something about the returns. Today, companies like Sun Communities and Equity Lifestyle Properties, the firm Zell built, own hundreds of communities and hundreds of thousands of lots between them. RHP Properties, backed by names like the Canadian pension fund CDPQ and by Wall Street institutions, runs hundreds more. The affordable, invisible, mom-and-pop business became an institutional asset class. And these are not landlords absorbing costs quietly. Heading into 2026, Sun Communities and Equity Lifestyle each sent rent increase notices to around half of their manufactured housing residents, averaging roughly 5%. 5% on a fixed retirement income every single year, on a home you cannot move, is not a rounding error. It is the model working exactly as designed. And when the funds arrive, the rent roll math stops being theoretical. When Haven Park Capital moved into Iowa, residents reported lot rent increases of 25 to 69% after acquisition. In one Michigan park, residents' costs reportedly rose 40% through new rent and new fees. At a park in Iowa City, residents said their lot rent roughly doubled after the new owner took over. The residents own their homes. They cannot move them. And the rent is the one number the owner controls completely. And the rent is not the only lever. Once a park changes hands, the line items multiply. Water, sewer, and trash that used to be folded into a single payment start arriving as separate charges. When the owner upgrades a water main or a road, the cost is often passed straight back to residents as a monthly surcharge on infrastructure they did not request and cannot decline. Late fees, pet fees, and utility bill backs pile on top. For the operator, every one of these is more income flowing into the same valuation formula, which means every new fee is not just revenue. It is another lift to the price of the park. For the resident on a fixed income, it is the same home they always owned, quietly becoming more expensive to keep standing still. Now here is the part that should surprise you. The most famous value investor alive is deep inside this business, but not where you would expect. Warren Buffett's Berkshire Hathaway owns Clayton Homes, the largest builder of manufactured homes in the United States. It also owns the largest lender financing the purchase of those homes. So Buffett builds the house. Buffett lends you the money to buy the house. Buffett does not, as a rule, want the land underneath it. Think about what that tells you. The single most patient capital allocator in the world looked at this entire chain and chose to own the factory and the bank, the two ends that scale cleanly and carry no angry tenants. He left the land to everyone else. The land is where the money is made, and it is also where the fight is. Because there is a fight, and it is growing. Around 20 million Americans are estimated to live in manufactured housing, though even that number is disputed. And industry insiders argue the real figure is closer to half that. Whatever the exact count, it is the largest source of unsubsidized affordable housing in the country. There is no government program behind it. It exists because it is cheap. And the reason it stays cheap on the home side is the same reason the land side is so powerful. Almost no new parks get built. Local governments rarely approve them. Nobody wants a trailer park zone next door. So supply is effectively frozen while demand for cheap housing only rises. That freeze is the investor's dream and the resident's trap. You are buying an asset they are not making any more of, occupied by people who structurally cannot leave. Rising rents do not reduce your occupancy, because the alternative for the resident is to abandon or sell a home for a fraction of its worth. Some states have started writing tenant protection laws, giving residents notice periods or the right to match an offer and buy the park themselves. A movement of resident-owned communities is growing. But it is early, and it is small against the weight of the capital moving in. So let's add it up, because the full shape of this thing is stranger than any single number. You would be buying the lowest cost entry in real estate, often $10,000 a lot, on land they have effectively stopped producing, occupied by homeowners whose largest asset is physically anchored to your dirt and who cannot afford to move it, in a business where a rent increase of less than $1 a day can lift the value of the whole park by $500,000, where the fifth largest operator in the country openly calls his residents hostages, where the most celebrated investor in history owns the factory and the bank, but deliberately not the land, and where 20 million of the poorest homeowners in America are the ones quietly funding the returns. It is, on paper, one of the most efficient wealth machines real estate has ever produced. And every dollar of that efficiency comes from the fact that the people who live there own their homes and can never take them with them. You decide.